And within short-term assets, you'll have certain line items, okay? And within each particular line item, this is where the GAAP rules come in, right? What's the difference between cash equivalents, and short-term investments? It's the GAAP rules that define whether a dollar or a note or a CD is bucketed into one of those three different groups. On cash flow, we have the sum of the cash flow into and out of the company's bank account during a certain period of time. So on the cash flow statement, it's cumulative, all right? So the cash flow statement really doesn't make sense if you say the December 31st cash flow statement. Instead, what you want to say is the 2006 cash flow statement, right? Or the cash flow for the first half of the year. Now, cash flow statements are a little unusual in that they generally will take either the first 3 months, the first 6 months, the first 9 months, or a full year of cash flow for a company, all right? But you will not see, on a financial statement anyways, the cash flow for the third quarter, all right? It's just tradition, it's the way it's done, but it's either the first 3, 6, 9, or 12 months, all right? It is cumulative like the income statement, but with the income statement, you'll see the income for the first 3 months, the income for the second 3 months, meaning April, May, and June, and then the 10Q will have the third 3 months and the fourth 3 months, okay? It's also cumulative, as I said, and on the income statement, you're using accrual accounting, whereas on the cash flow statement, you're obviously using cash-based accounting, all right? There are 3 different types of cash flow, all right? The cash flow is broken into operating cash flow, right? So if we go and we use an example of a widget company, the widget company, its suppliers are plastics companies. They give you plastics. The widget company forms the plastic into a widget, and then sells it to children, who are the buyers, okay? If you're taking a look at the cash flow statement of a widget company, its operating cash flow is how much money it generates selling widgets, okay? And it takes into account the expense of buying the plastics, the revenue of the sales to children, and the net income is the difference between the two. You also have your investing cash flows, okay? So your investing cash flows could be thought of money going around different places on the balance sheet, but not coming off the balance sheet, right? So maybe money goes from short-term investments to long-term investments. In our previous example, maybe you convert cash into a building. That would be an investing transaction. That would never hit the income statement, but it would be shown in the cash flow statement under investing cash flows. For example, under plant, property, and equipment, okay? The third bucket in the cash flow statement is the financing cash flow, okay? So under financing cash flow, this is money coming onto or off of the balance sheet. Let's say that the company decides to issue some bonds, right? It's giving out an obligation, and in return it's taking in money, right? Money comes onto the balance sheet. Let's say it decides to buy back some shares, all right? It goes out into the marketplace, it gives cash to shareholders, and it takes those shares back into the company's treasury stock, all right? So operating, investing, and financing. These are important concepts to remember because as we go forward in this section, you will see that U.S. GAAP is shaping up for some pretty fundamental changes. And they will be changing around the balance sheet and the income statement rather dramatically to make it look more like the current cash flow statement. Okay? But these are the 3 statements. Now, this one's a little difficult to see on the screen, but hopefully you can see it better on your computers. This is what I was talking about the changes that are going on now. FASB, which we discussed, is a self-regulatory organization, is talking about changing the structure of the financial statements. So on the right, you have the current statement of financial condition or position. It's what you and I would refer to nowadays as a balance sheet, right? And as you go down through there, you'll see that the familiar line items. So cash, right? Trading securities, okay? Accounts receivables, etc. Okay? And one of the things that you will notice is that on the left, they've changed this around significantly. So now you're talking about business or operating assets and liabilities, financing liabilities, and income taxes. All right? The other thing that you'll notice here is a lot more line items. Okay? So the line items here have increased substantially. So one of the things that has advocates for public companies, like the U.S. Chamber of Commerce, concerned is that as FASB creates more detail in financial statements, create more accounting costs, right? Because there's going to be that much more decisions that have to be made by CPAs and that much more liability for getting a transaction put into the wrong position. Okay? So, if we take a look through some of these items here, you will see, and I think if you click on it, it'll actually pop out for you so it's easier to read. You'll see on the left we have accounts receivable, okay? Less allowance for bad debt. That's not something that you currently do now, okay? You will have accounts payable, accrued liabilities, okay? Dividends payable. They break that out as well. Why is it that some of these line items are important to have? Why is it that you think that this additional information, like dividends payable, is something that an investor would want to know?
It gives you a better picture, more accurate picture of the future. It's right now, it's the liability you have to pay. You know that by that time, that you can anticipate to pay that for sure. So right now, based on that information, you can make a better judgment.
Okay. I generally like the answers, more precise and parsimonious. I think the most precise and parsimonious answer is that investors are generally interested in operating results, not investing in financing results. Okay? When you invest in a company, you're investing in the business. Okay? If a CFO is making investing decisions about whether to have money in cash versus short-term investments, if you need to build a new factory in order to make the widgets, that's not really what concerns an investor. An investor is interested in margins. How profitable is your business? Okay? How much money are you investing in R&D so that growth continues into the future? All right? How fast is your revenue growing? Right? What is your SG&A margin? How much of that SG&A is fixed versus variable? In other words, do you have leverage? If your revenue doubles, will your net income double? Or will it go up fourfold if you have fixed expenses? Generally, investors are focused on the operating results. And one of the problems that you have with the current configuration of financial statements is that a lot of the non-operating stuff, like depreciation, gets mixed up with the operating results. So if you go through an income statement and you start taking a look at, for example, cost of goods, SG&A, R&D, which one of those contains the depreciation?
Cost of goods.
Not always. Actually, not generally. Generally, it gets stuck in SG&A. And it won't always tell you. Oftentimes, what you have to do is you have to go to the cash flow statement where they subtract it out in order to figure out where it's been put. Okay? The other thing that accountants would like to see more of is splitting up depreciation according to the source of the depreciation. So if the widget company has a factory that makes widgets, has an administration building where the CEO and the salesman and everyone else hang out, and then has an R&D facility where they plan how they're going to make new widgets, each one of those should be depreciated on a separate line item, with the factory being depreciated on cost of goods, right? The administration building being depreciated through SG&A, and the R&D facility being depreciated through R&D. Okay? These are the types of things that they would like to see. But again, one of the things that you run into with accounting is that even though accounting tries to create rules that are consistent that allow comparability, you're actually allowed a great deal of latitude. Now, we discussed some of the latitude when it came to depreciation, 3 different ways in which you can depreciate things. There are also other rules for example, how you do inventory. LIFO versus FIFO. So you can be comparing one company with another company. One company is using LIFO, one is using FIFO. You'll get very different margins when you take a look at your COGS margin or your SG&A margin. You had a question?
Yeah, I was about to say, are these then footnoted